Time for a Q&A. First question. I think if you get a sus jobs report, I imagine that means suspect, why would it be to the upside? Trump wants rate cuts very bad and to issue more than... Yeah, he does want rate cuts very bad, but he doesn't want to lose. You see, he's not the one doing the rate cut. Somebody else is, so he'll always have somebody to blame if things go wrong. However, under his watch, to show job losses, he cannot have that. That cannot happen. He would rather it show incredible job gains. And then if there is no rate cut, completely blame the Fed, start advocating, and well, he doesn't really advocate, start bullying and name-calling even more, and if something goes wrong, then he can blame the Fed. So if I had to bet, if it were a doctored report, it would be doctored massively to the upside. I suspect that if there is something wrong with the jobs report, it would be a very report with high unemployment rate and negative non-farm payrolls, not a good one. A bad jobs report would give him more rate cuts. Yeah, so I think I've made that the point that I wanted to there. Okay. On one thing on YouTube Premium, you mentioned you'd not have premium to support the creators. Creators get paid more if a premium subscriber watches a video than if a normal viewer watches an ad. Oh, I didn't know that. How did they get paid? I mean, part of the subscription revenue, I guess. Happy 40th. There you go. That's better. Somebody was wishing me a happy 83rd birthday on YouTube. 83. Lulu and Broadcom on Thursday after hours, not Friday. Yeah, you'd seem to think that these guys could get it right. Like, it's such a simple... you know what? I'm not going to get started on that. I don't understand this. You're not the oldest guy in the room. Every day that passes and people ahead of me in the world pass away, I get closer and closer to being the oldest person in the world. Why do you think the market is not reacting negatively to Trump's stacking of Fed? Because right now they're only threats. The market did not react when Trump threatened tariffs, because everyone thought, well, he's not really going to do it the way he says, is he? It's not really going to happen that way. Sure, he says that, but certainly somebody somewhere is going to talk some sense into him. And then you saw the shit show execution that happened after that. So I think that people are as complacent again, as they are with almost everything he says he's going to do, is that, oh, well, somebody will talk some sense into him, or it won't happen that way, without realizing that he does not surround himself with people who talk sense into him. He surrounds himself with people who carry out orders, loyalists, period, end of story. And yeah, I'm sure at some point there's going to be a independence crisis, that it will be threatened, and the market will probably react then, and only then will he somewhat back off of that. But market's hitting all-time highs as he's threatening this. He threatened to fire Lisa Cook all last week, Thursday, all-time high on the S&P. So it's giving him permission to continue doing what he's doing. He's looking around saying, look, everyone's okay. The market's hitting all-time highs. Nothing is broken. I have permission to go further. Until the market is down 10, 15% on this, will he then back off and say, okay, there you go. So if the market truly doesn't want this to happen, it would react. Now, the long end of the curve is, well, it's acting like it's always acted all year long. You know, you get a rally to 87, 87.50, 88 on TLT, and nope, right back down. You get to 86, 85, 50, and no, let's get back up. So we're in this range, and he's doing all of this stuff, and we're in the same range. Again, there's permission. I know you and others are generally skeptical of technical analysis, given that equities move in random walk, so past price action would not be predictive. I wouldn't say equities move in a random walk. I believe strongly in a drift component to equities, but in that drift, it is a random walk. That much of what you see and much of what creates pattern is randomness. That if you really want to see a good indicator, a 200-day moving average is probably your best indicator to catch the trend. If it's upward sloping, gently upward sloping to the right, that's really all you need in the trend. Everything around that trend, I think, is just noise. But you have talked about positive upward drift where stocks tend to move up over time. Are the two? Well, let's think about this. Let's think about your career. You go to university and you get a job. And let's say you have a starting age of 25 and you're going to retire at 65, and let's put 100K in here, and that's where you start. And each year you're going to get a raise, right? Sometimes you get bonuses. Sometimes your bonuses are really big. Sometimes they're not as big. And then you decide, well, I'm going to leave my job for a period of time. And then you get another job, and it's, and there's where you end at 65. Let's say that was your income. Why is it upward sloping into the right? It's because you're worth more over time. You have more experience. You're better at your job. You're better at what you do. You become an expert in a particular thing, and your income goes up. Even if you don't get better over time, your income does go up at the rate of inflation. Would you then apply technical analysis to this? Would you then say, all I need is this, and I'm going to draw some lines on this thing? Or would you say, but why? The up and to the right is fully explained by experience, knowledge and experience and expertise over time, fully explained over time. Well, companies are the same way. Companies start selling a product, then they start selling more of it. They introduce a second product, they get bigger, more people like their product. You don't need technical analysis and lines on charts to figure out that the price action should increase over time. They are getting to be a more popular company, a more profitable company, a bigger company. So what would happen with their market cap? It would increase. Market cap divided by share count is share price. Share price would increase. You don't need technical analysis and lines on charts to figure out the drift is upwards and to the right. So no, I don't think that a drift component has anything to do with technical analysis. It has to do with the firming of the fundamentals. It will drift in the direction that it's firming. You have value versus growth, right? And if something is growthy, it should drift upwards and to the right. Value would probably be somewhat lower. A more mature company that's a value company doesn't really see those big kind of gains. Eventually, this growth company, if we drew another chart starting here, eventually this growth company is going to become a value company, and there'll be other growth companies that if we drew a chart over here, this would become a growth company over time. Some of these growth companies over time just sort of stagnate. Some of them begin decline before they start to turn around again. You can see all of this in their financial statements. You don't need lines on charts and 8,000 different indicators that point to absolutely nothing. So whenever somebody brings in the technical analysis thing, I sort of just think, but you can tell this story in a better way. If you got lines on charts, you don't know what the story is, so you don't know how big the story is. So I can give you 4 charts with technical analysis on it that all signal. They're flashing buy signals. You ever hear somebody say that? Our systems are flashing buy signals. Shut up. Anyways, I can give you 4 charts that say buy signals. How are you going to size them? You're looking at them and, okay, yeah, that's a signal that says buy. That's a signal that says buy. How are you going to size it? Well, how many shares are you going to buy of each? Which one are you going to overweight more than the others? You don't know. Why? Because you don't know any story. You don't know what the future holds for these things. But if you have the fundamentals, you have the story, you can look at a chart and you can say, this one here probably will continue in this direction, has good fundamentals, but it's not a big growth story. But this one over here, this is there, this space, I want to be in this space. Only with that would you know what to overweight. Now, the technical analyst might say, well, you can do both. Figure out which one you want to overweight and wait for the charts to tell you when there's an entry point. But why? If you're day trading or if you're just swing trading or scalping, then sure, maybe you need all the perceived advantage that you can get because you're betting randomness. You're just gambling at that point. But if you're going to invest in a space for 2-3 years, your entry point doesn't really matter. So I don't, no matter which way you bring it, I see no reason for technical analysis other than to give people an illusion that they can control something that they don't understand. I get why you're not a big fan of consumer expectations, but if consumers are expecting inflation, then wouldn't they act in a certain way and make the very thing happen, even though they're quite wrong? It would be hard for the consumer, I think, to affect prices. I expect inflation. I don't know how I can then lead to higher prices if I expect inflation. Maybe if I expect inflation, I'm going to buy everything today, but I am capacity constrained in how much money I have to spend. But to say that is to not say anything different than what most 80%, most Americans already do, which is spend every penny they get the moment they get it. So if you were expecting inflation, you'd bring forward all your spending to today. But I've just described what Americans do on an average Wednesday afternoon, right? So I don't know that they would change much of what they do. And even if they said, let me buy everything today, they'd probably realize that, hang on, I've been doing that for years. That's why I'm broke. That's why I have no wealth. That's the reason for the inequality. Oh my God, it's my fault. Don't look for that introspection. Now, they may ask for higher wages, but the company that has them, I don't know of any organization that would start handing out significant raises for no other reason than your employee expects that prices are going up. There'd be, I think, a large enough merit component in there that you would be getting a raise that is more than inflation if you have merit and the company needs you and the company wants to keep you. Other than that, you'll get the typical annual raises no matter what you think is going to happen. The company's not going to say, oh, I'm sorry, you think that inflation is going to be 9%. Oh, I was only going to give you 5. Here's your 9. You'd walk in that room every year with your inflation expectation in hand saying, I think inflation is going to be 8% this year, 9%, 15%. So it sounds good on paper. They'll start asking for higher wages, which will drive up prices. It's like, well, hang on. They'll start asking for higher wages, full stop. Only if management truly believes the same thing and says, well, that's true, and that their revenues will increase at that expected rate of inflation, would they then agree? We always just sidestep the person that has to agree to it, right? Oh, well, they'll ask for higher wages and prices will go up. It's, wait a minute. You jumped right over the person who has to say yes. Gotcha, so told you after all, you won't fool me. I don't know what that means. Great choice on choosing Google Pixel. I'll be buying it when I get back to Canada. I already have a phone. I get a Pixel. I don't know if 2 phones can have the same phone number. And I don't know that I want to get rid of my Apple. So I'm going to have to figure out what I'm going to do with it. But I don't have to use it as a phone. It is a mobile device with a phone feature. It's not like it's a phone that has a few extra features. It's a device with a whole bunch of features, one of them being a phone. So maybe I can just use it that way. I only have a bachelor's in finance, work in corporate planning and performance. I want to start contributing to finance research. I do have some ideas and questions I'd like to explore, but with no formal research background, I'm not sure how to begin. Should I start by just gathering market data and running small stuff? Well, let's figure out what kind of research, when you say finance research, that you want to do. Do you mean practitioner-facing research, or do you mean academic research? If you mean academic research, you're going to need some training in how to speak that language, because you'll read some academic papers sometimes, you'll say, I have no idea what these people are saying. It's like, yeah, that's what they do. They think they're saying all these incredible things because they're using all these very specific words, but no one's listening. If you mean practitioner-facing research, your best example of that would just be grab some research reports that are written by analysts and have a look at how they're written and how they're structured, the depth of the research, and the purpose of it, what it is they're trying to convey, and read it and see if you understand it. Most of the time you can, so that you don't have to be trained in research methodology just to understand the paper. And there are certain skills you need in writing a research report. You don't necessarily need financial modeling, but you need a financial model, which could be done by anybody who knows financial modeling, but it would be driven by your assumptions. Financial modeling really in these reports is just a small part of something. It's much like saying, thank God the person writing this report was an expert at Microsoft Word. That's what you have to be if you're going to do this. You got to be an expert at Microsoft Word. You'd never attribute the output to Microsoft Word, because of course you're going to use Word. It's a tool, but you'd never attribute it to that. No one's saying, I need to learn Word to write these things. It's just something you do. Well, a financial model is just built in Excel. It's just a way to show how your forecasts will unfold over time and how sensitive that forecast is to your assumptions. You do some sensitivity analysis. But somehow we think that, it's all about this financial modeling in Excel. And it's not. Excel is a very small part. You could just get somebody else to do the model for you. Everything is your assumptions. Everything is your assumptions. So if you read these reports, don't worry too much about the Excel side. You can always have somebody do that for you. That's probably the best benchmark to use. Should I start just by gathering market data, running some small studies? Statistics is a funny little thing. You have to use the right type of statistical technique depending on the type of data that you have. So there, I would say, if you don't have a good solid understanding of econometrics, if you're going to be doing economic data, econometrics is just a fancy word of saying regression, but with economic data, which has its own peculiarities. So it has its own tests for certain things. And if you don't have a good understanding of, if you're doing more fundamental research on companies or return series or things like that, and you don't have a good statistical background, it's going to be difficult to produce tests of your hypotheses on that data without having that understanding. I want to confirm if you have decided to discontinue the positions update weekly. No, I have not. I'm not going to discontinue it. It's just, I'm here in Costa Rica, and I had some seminars, and I really didn't do anything other than 2 or 3 trades a week for while the seminars were going on, just to show how it's going to work out in a portfolio, just to show how you would do the trade setup and then how you would manage it over time. So that's all I'm doing, and it's nothing that I really care to share because it's nothing I have conviction on. I'm just showing examples of how you would do things. I'm using real money to do it because it doesn't make any sense to do in a paper portfolio. There's no fear of failure in a paper portfolio, so you got to use real money to get it done. But I have not decided to discontinue that. The market outlook plus the positions update give a great training ground on how to think about asset allocation as a whole. Yeah, don't worry about it. On Friday, I will put one up. So Friday I will, but I will not use this screen. I won't use this screen to do it. When I just did it in video form, just with me on the screen, the reaction was very, very positive. That was a better format to do it with. So I'm going to do it in that format. And then I'll just have my portfolio open and I'm just going to read down the list. Making the screens can sometimes take an hour to do before you even begin to narrate, but with my portfolio open, I can just narrate right down the side of the list and tell you what I have, when I did it, why I did it, and what my purpose for it is. What did I do that I could share with you now? On, I think it was Sunday. I think it was Sunday night. It was Sunday or Monday night. I forget. It was before Tuesday Open. I think it was Sunday night. Yeah, it was Sunday night. I was discussing the Fed funds rate, and I get to 5 rate cuts really, really easy. I can't see how you're going to get less than 5 all the way to October of 26. Because I think you get 2 this year, and you probably get 1 more before Powell goes, maybe even 2, so that he can feel that his job is done. But then you get 3 meetings ex-Powell. How you're not going to get 1 or 2 in those 3 meetings, I don't know. So 5 to me seems like a no-lose situation. That would put October ZQ at 96.92. And it was sitting at 96.96. I think 200 to 250 is what you're going to get with a Trump-controlled Fed. You're going to get a lot more than what you think, and I think you're going to get that whole curve coming down. So I bought 100 contracts at 96.96, and then it dropped to 96.92 on the Tuesday during the day. Or was this late at night on Monday? I forget when it was, but I bought another 20 here. Then it dropped to 96.90. I bought another 20 here. So I've got 152, and I want somewhere between 400 and 500 of these. So hopefully the jobs report this week will give me something that I can then grab more of this stuff. But Waller earlier, I think yesterday, came out and said he sees multiple rate cuts by the end of this year. Well, I only need 5 in 9 meetings, and he sees multiple rate cuts. What if you get a double in September with 2 more cuts by the end of the year? There's 4 of the 5 gone. I don't think that's unrealistic. Question about mREITs, like agency that primarily hold agency MBS. Unrealized gains, losses on market value of MBS are not usually important since MBS are typically held to maturity, right? That one, I don't know that I want to say yes, they're all held to maturity, period. I don't want to say that for sure, but they're certainly not held for 6 months at a time. They're not managing to a particular duration. So let's take TLT. TLT targets a particular duration. So when it buys long-term bonds, we know that at some point it's going to sell those long-term bonds to buy other longer-term bonds to manage its duration at a certain number. I think its duration is somewhere between 16 and 16.5, somewhere in there. Mortgage REITs don't have a duration. They hedge out the interest rate risk component. So if you look at their balance sheet, you'll see a treasury position. It is a short treasury position. so that if interest rates increase, their treasury value will increase, but their MBS value will decrease, thereby hedging out the interest rate component of the MBS, and then they lever up the spread being the difference between a benchmark like a 10-year and what the MBS is paying. So because of that, because they don't manage to a duration, they're more likely to hold that to maturity, but that doesn't mean that they would necessarily hold it to maturity, but they are more likely to do that. I don't recall reading in their 10Ks that their strategic focus on this was that they were a hold to maturity buyer. More likely they would be, I would seem to think, but I wouldn't want to say 100%. We use things like net interest income, dollar roll income as important performance metrics rather than EPS, correct. But that makes me wonder why they often short U.S. Treasury futures to hedge asset market. I just told you. So you have an MBS, right? And let's say that is the total return you're getting. Some of it is going to be attributable to the interest rate. Some of it is the spread. And they'll short a Treasury to nullify this, and then they'll try to lever this up. I think agencies somewhere around 8x. In good times, you'll go as high as 12x, but you lever that spread up 8 times, 9 times, 10 times, 12 times. That's where the money is. Wouldn't they eventually realize gains, losses on derivatives meant to hedge gains, losses on? Yep. I have a question about risk I could be overlooking with retailers. I've been selling puts and doing covered calls on retailers and department stores like Macy's and Gap. Macy's probably got called away from you this week then, lately, because the IV is awesome. Yeah, IV is nice to have when you get it, but if you have an industry that is typically 25 to 30, suddenly over 40, the market's trying to tell you something. Financials are pretty stable, valuations like PE are low, so it's interesting to me why the options market would price in so much risk. Options markets are always forward-looking. What you are looking at when you say financials are pretty stable, that's any statement you're looking at is is the past up to today. Investors buy the future, right? Of course, they all face the threat of online shopping, and some may have slight negative growth, but still doesn't seem like enough to warrant such a high IV when valuations are this cheap. Am I missing something when it comes to the risk of these companies? Many retailers, keep in mind we have tariffs, right? Many retailers import their stuff, especially clothing. None of that is really made in the USA. I think there's very few companies that actually have any domestic production of clothing. All of that is coming from outside the country, so that is all facing tariffs. And with the Orange King, you don't know if those tariffs are done. You don't know who's going to be meted out for special punishment because they didn't say they voted for Trump or that Trump was the best. You don't know what the Orange King's going to do. But that is the sector that most definitely is going to have a tariff effect. And there is a sort of I wouldn't call it a general agreement, but a sort of a head nod agreement that there are way too many retailers in the U.S., especially in the clothing segment. There are just way too many. You know, when you go to the mall and there are 23 stores for clothing, after a while, those stores all sort of start to look alike. There's a big category of them that all looks alike. And there's just too many retailers, so some are going to go away. But that's the big deal there, is the tariffs and where will it end, and who's going to swallow what amount of it. The exporter, the country that's exporting, the company in that country that's exporting may take a hit on some of it, but the importer, which are the companies that are selling it to you, they're taking a hit on some of it and passing some along. So the thinking is their margins are going to shrink, and if their future cash flows are going to shrink by the amount that they're absorbing the margin, then they're not worth as much as they were yesterday. But that's their deal. How can you hold these two following beliefs at the same time? During the last market outlook, I've heard you say that it's difficult to compete with the big guys when you're a small IT company. But with AI, you can improve the productivity of the crew you have. This is true. This is part of the argument as to why small caps should outperform large caps. However, when discussing AI, you also mentioned that it will be the biggest benefit to those that are already an expert. Wouldn't those experts already be in the larger firms, and wouldn't the gap therefore widen? Well, when I say that the biggest beneficiaries are going to be the experts, I mean in terms of their own personal income. The gains are going to accrue to experts, so that if you are an expert, AI will make you so much more productive and even better. You're going to be worth a hell of a lot to the company you're with, and if they don't pay you for it, somebody else will. So their wages will go up. I didn't say that the corporation that has the most experts will be the winner. I said the gains will accrue to the experts. As far as which organization is going to benefit the most, I think it is the ones that are probably most capacity constrained to begin with, which is the small companies. Now, I'm not saying that large companies aren't going to benefit. I'm just saying for dollar of revenue, per dollar of revenue, I would expect the productivity of smaller firms to be higher than the productivity of larger firms. But the head counts, I think, at larger firms can decrease to offset the extra that they're going to have to pay their experts to keep them, because other people will buy them easily. What if your staff are watching Market Outlook and also own TLT, and they know you will be getting the real-time translation earbuds? Well, no one's gonna know that. I'm gonna see if that stuff works. Apparently, the Pixel 10 has real-time translation. So I'm thinking if I have voice translation, if it's real-time voice translation, and I'm wearing these Pixel buds, should I not be able to hear it? Remember a couple of weeks ago I was saying, this is coming, this is coming. Is this it here? I don't know. I'm going to find out. And then I'm going to find out what everyone down here is saying about me. Happy 29th birthday. Another trip around the sun. Well, now you're just pandering. 29. I'm not 29. But I'm not 83. You know, if I had no idea of how old I was and I had to guess, I would be saying something younger. I do not feel my age. But I am very well aware that when I look at pictures, not in the mirror, when I look at pictures of myself, I don't look 29 anymore. I don't look 38 anymore. Do you have any plans on making any video on philosophy, how money works, meaning of life? I don't know that how money works is a philosophical issue. I don't remember anything from Plato or Aristotle, and I'm really thinking hard. It's not really my thing. It's nothing that I actively do. Every now and then I think let's do something here. But it's nothing that I really do. Meaning of life, well, if you figure it out, you tell me. I think instead of saying the meaning of life, that's a big question, right? Meaning of life is assuming that there is some meaning to life itself. I don't know that there is some meaning to life itself other than just it will show up whenever there is an opportunity. I don't think it is rare. I think it is a constant in the universe, that the universe has within it life everywhere, in lots of places, maybe in ways that we don't quite always recognize. I think it is a constant, not just one blue dot that has it. So I don't know that there is a search for that, because I don't think there is one. It is just an accident of the physics that define the universe and the biology that exists within that physics that says, hey, look what happens. Because look at how many different varieties of life there are just on this one planet. I think if you change it to the meaning of your life, now we have something. And I've said many times before, do not chase happiness, right? That I want, the pursuit of happiness. I think that should be changed. Don't chase happiness because it's elusive. You're only happy for a little while, then, okay, great, that happened. Now let's get happy again. Chase meaning. If you have meaning in your life, and what is the meaning of your life? It's different for everyone. That's the thing you have to figure out. What is the meaning of your life? And then just take everything else as a nice, happy, cosmological accident that life exists in the universe, that the universe is such that life is a constant. Another question about mREITs. Listing Q2 earnings call for agency management mentioned their MBS current coupon spread to a mix of U.S. Treasury and swaps about 180 basis points. They utilize 7.6x leverage. Management concluded that this puts their ROE at about 19% long term. 180 basis point spread between their assets and the 7.6 times leverage should only equate to 13.7. How do you get there? It should only equate to 13.7. Yeah, but keep in mind they have debt and equity. You're looking at maybe you're saying that would provide a return, a total return on. Well, you're just actually that is not even the 180. The number that you're getting to, you still have to subtract all of your expenses off of that. That's 180 basis points, and you're a little bit off here on the calculation. You have to take 180 basis points multiplied by your assets under management, because that's the spread you're making based on all the assets you have, minus all of the other expenses you have, including your interest expense, to get to your net income. And let's just leave out market values for now. Let's just worry about the net interest income and dollar roll spread. Take your expenses out of that, and then just divide that by your equity, not by your total capital, just your equity. How do you go from 13.7 to 19? Leverage, right? Leverage. Threatening their current 16% dividend yield. It is a REIT. They must, based on their tax return, whatever income they have on their tax return, not their financial statements, their tax returns, they must pay out almost all of it. Like some 95% of it has to be paid out in dividends. That is a law. Otherwise, they don't keep their REIT status. And if you get a lowering of the Fed funds rate, right away their interest expense drops, because their interest expense are all repos. Their interest expense drops. So they become more profitable as we go forward. What do you think about this company? On to something. Don't know anything about that. Do you think that potential? Good company to invest in? No idea. You should be asking me much more specific questions, not these kind of questions. Right? Don't outsource your thinking. Think as much as you can on your own. Determine for yourself if it is a good company. Now you can ask me a question like, so this company's in the industrial sector. What should I use as a valuation technique on this? And okay, well, that's a very specific question that I can answer for you. But to say, what do you think of this? Is it a good company to invest in? You're outsourcing all of your thinking to me, and unless you're willing to do the deep dives to get to your own thinking, you'll never get there. You'll always be outsourcing your thinking. You'll always be relying on what do you think of this? What do you think of that? The right question is, what do you think of that? Based on what you've read, you must have questions. You know something about the company, but you're uncertain as to whether or not it's good. Why? ask those questions. Ask questions that lie in the space that you do not know and that you don't have the experience to get, but don't ask questions that lie in the space of effort that you could put out. That will make you better over time than people will be asking you, hey, what do you think of this company? And you'll be saying to them, don't ask me that question. I know you follow TLT a lot. Really? Something gave it away, I think. There's a common pattern for DLT. It says, okay. Let's see. What if sweep is just another? Oh, okay. That's all that stuff. Fed also paused 10-year minus 3 months uninversion. I don't know that the Fed paused that. That is the market that would do that. Been around the zero for a while. Yep. We're going to get further uninversion when rate cuts arrive. True. That's probably the start of a bear steepener. You can get a bull steepener. You can get a 10-year that does not move at all. And the short end of the curve goes down. That would be considered a steepener, but I don't know where the bull would be or the bear would be, simply because the 10-year didn't move. If you think about it in that sense. So I don't know that I would automatically conclude that you're going to get a bear steepener, that if you cut the short rate, the 10-year yield will go even higher. I don't know that you can conclude that. I was just seeing on the news the Google antitrust ruling and saw their stock jumping after hours, higher and much closer to your assessment of the company's valuation. I had considered purchasing some of the stock alongside you when you mentioned the market outlook, and I did not, because I didn't feel like it made sense for me at the time, and I didn't fully understand your strategy going in, and there's nothing wrong with that. I mean, you could say, oh, you missed out, but you got to have rules, right? If you don't understand what's going on, don't do it. If you don't understand something, just stay away, because you're not going to know when to get out if it's wrong. And everybody has to do what's right for them. People buy crypto, I don't. People made money in crypto, I don't. Why? Because it's not right for me. It's not something I'm comfortable with at all. It's not something I want to get to know. I'm happy in the sandbox that I'm in. There's nothing wrong with that statement. Listening back August 10th section talking about Google, you mentioned being long by shorting the puts. Yep. You mentioned the September puts, September closing. I re-listened some of the Google talk on August 17th. You did mention the antitrust case and even acknowledged that was one of the reasons why it wasn't trading for its multiple. Now, if the antitrust is out of the way and it starts trading for a multiple valuation you estimate, 225, 230, do you exit the position with your puts sales? Well, what happened was the 190 puts for September, I closed them at 11 cents. So that was done. That day, before they announced, because I have people here, so I was busy that day. But in the morning, I said, I'm going to roll my Google put from 190 to 230 for December. And then the day just got away from me, and I never rolled them. And then that night, the news came out, and it was like, well, it's pretty much over. And the 205 puts for October, I think there were like $1.50, $1.45, $1.50, closed those. So I'm out of Google at this point. Give me a nice pullback, and I will probably do the 260s for December. Nice pullback, I mean, if I see it 225, 224. Let's see if the jobs report this week gives us anything to be bullish on duration, bearish on equities. Wouldn't that be a beautiful day? Let me go shopping again. But no, I think it goes that behind it. I think you could put 2 to 3 multiples on it because of that. However, keep in mind, they've still got a $200 billion problem to solve in revenue, which is Google search, URL searching. Who URL searches anymore? Apparently, according to Google, a 12-13% increase in Google searching. They have to get an AI, and globally too, not just the US, but globally too, they have to get an AI browser in there working and figure out how do we monetize search in an AI world. I don't see that they have a solution for that yet. And even though I pay them the big money each month, Not everyone is going to do that. It's going to be hard to come up with $200 billion of revenue by selling subscriptions or embedding your AI in products. So they're going to have to solve that somehow. I don't see that they have that solved, in which case I don't know that you can go fully in. Because you get rid of Google ad search revenue, Google's revenues get cut in more than half. Got to solve that. Got to solve it, folks. No one's ever seen anything like this. Okay. Do you exit the position when you put says, I haven't traded options for a number of reasons, so I don't understand your option strategy here, and I'm curious why you approach the situation with an option strategy instead of purchasing shares. If you purchase shares, here's what happens. Let's say I purchased 100 shares. It was at $195. There's $19,500 US dollars that you need. Now I have Google risk and I have US dollar risk because I bought a structured product. A structured product is a product that combines a bunch of assets into one thing and you look at one price. So I have US dollar risk. I don't want US dollar risk. So how do I get the upside of Google without getting US dollar risk? In the money puts have very high delta. So I get to keep this and let's just say I have the 19.5. I get to keep the 19.5 in cash, of which I'm getting 4.33% on in terms of a money market rate. When you sell puts, you get money in your account of which you're getting 4.33% on. I would have no FX risk here. Well, I guess I still would have FX risk because I'm making the example I have US dollars. But if I didn't have US dollars, let's just get rid of that. I would keep my Canadian cash, which is my US dollar times 1.38. So I have more Canadian cash, and I think that's getting, call it 3%. 3%. And then I sell the in-the-money puts. I get US dollars in my account, of which I'm making 4.33%. No FX risk over here. The only risk I have is the premium that I got on the put, so I avoid most of this, so I only have exposure to Google. And if I can get my deltas with a combination of out of the money, that's the 190 puts, plus the in the money 205s, and then you stagger these in terms of a timeline. This is your out of money, and then you go a little further and you go in the money. You can get a delta on each set. You can get a delta very close to 1. So that's why I did that. And then what I was going to do is, because these were pretty much done, is I was going to hop these over to December, November or December, and go right to the 230s. However, the day got away from me. I didn't get it. And that was it. That was the end of it. Okay. Found your video on MicroStrategy very entertaining. I recall you were talking about the levels of volatility and how it helps the convertible arbitrage. I looked up the 1 month and 3 month volatility on the stock, and it's substantially fallen since the time when you have covered the subject. Yes, it has. Do you think the reduced volatility poses a significant risk for the strategy in the stock? Yes. It's not enough IV to issue any more convertible debt. And the company knows that. So it doesn't issue any more convertible debt. It issues convertible preferred shares with a dividend that is non-cumulative, cancelable and non-cumulative, which means if they don't pay you the dividend, they don't pay you the dividend. It doesn't accumulate. They don't owe it to you on the next payment. They're not going to pay anything on those preferred shares. All these people holding it thinking, yeah, I'm getting 8%, and if this goes up, yeah, I get to convert, are going to get nothing. Nothing. You only get to do that for a few quarters before word gets around, and then all you're left is selling your shares, and eventually you're an ETF, and you trade at your net asset value. That is the end goal. I wouldn't say the goal. That is the end game of this thing. Unless he can find a way to deliver volatility to bondholders and to keep that volatility alive, not going to happen. Now, volatility on Bitcoin has been dropping as well. So once you get that volatility gone, you don't have another product to sell. You can't package up volatility and sell it. It's gone. It doesn't exist, which means I now have to look at what you're holding on to, not the output that you can create, which is the vol. You can reduce levels of vol poses significant risk. Yep. Looks like Marco's birthday gift, though. Yeah, there's Google. Yeah, it was a nice. It was nice. Again, I wish I would have rolled my puts, but I'm holding Google. I'm holding Google buys when it gets 240. I may take profit. If when you say that, if it gets to 240, I may take profit. If you got like 200 or 300 shares and you think you might sell some at 240, make some money while you're doing that. Sell a call, because this jump up would have pushed its call implied volatility higher. That would have been the time to sell 240, 250, even 260 calls. Your opinion when it comes to deciding whether or not to marry a person, what's more regrettable, type 1 or type 2 error? They both are. But more regrettable based on what I've heard and seen. And you think, what have you heard and seen? I grew up with a grandmother. I didn't have parents. I was raised by a grandmother. So she came from a family of it's a French Catholic family. You can imagine the number. I think it was like 11 brothers and sisters. That poor mother of hers. 11 brothers and sisters. Well, they were all older, right? So as I was growing up, this one was, they all lived in the same city too, which is really, really incredible that none of them really went away. But they pass away. And your grandmother drags you to the hospital room where, you got to go visit them. And you know what you hear? You hear the list of regrets. It didn't take long to figure out the pattern. The regrets were always in terms of things they never did. Because the things we did, we may say that didn't work out, but we don't have a regret about them. You may say, well, that didn't work out, but I gained something from it. I gained an experience, a story. I got smarter. I got wiser. I didn't make that mistake twice. Or if I did, I didn't make it 3 times. Or if I did, I'm pretty stupid, you might conclude. But it was always in terms of the things they never did. I think probably not marrying the one. However, you also have to be careful not to engage in revisionist thinking. And I'm very careful with this, that when I decide not to do something, that I remind myself, so that I don't think in 2 years, I really should have done that. I remind myself at regular intervals that I'm making the right decisions for me. That was the right decision, because I do have this creeping feeling that later on in life I'm going to regret certain things. But I remind myself that it was the right decision. The other decision wouldn't have been good. But at the end of your life, most people are not introspective this way. That is how they measure their lives. No matter how well lived it is, this is the odd thing, no matter how well lived it is, very few people say I have no regrets, because there's always something you left behind. There's always something you missed. There's always an opportunity that for some reason or another you passed up. However, you're going to have to commit potentially a type 1 error to make sure you don't have any type 2 errors. So if you're making a lot of mistakes, if you're saying, my God, nothing's working out for me, maybe you're just too afraid of making a type 2 error and you need to back off for a while. Everyone has a type 2 error. And I think it's not so much the type 1s, but the type 2s that create, I think, much more character and interesting depth in people. Why did the market sell off after the tariff court decision? Wouldn't tariffs getting removed be better for trade? Well, the market, we had tariffs, including all the reciprocal tariffs, and markets were hitting all-time highs. So by taking them away, your argument is, shouldn't we be hitting more all-time highs? So do X, the market goes up. Don't do X, the market goes up. Do X again, the market goes up. In which case, is it even correlated anymore? The bonds, the long end of the curve went down, because this is probably the only thing that we can point to in terms of saving the debt. is the tax from the American people for their tariffs. Notice how I said that, right? The tax that American people have to pay to the tariffs to pay to fix the deficit so that the debt doesn't get worse. If you got to repay all of those tariffs and all of that, and you have none of that income coming in, well, there goes the deficit, there goes the debt. It truly becomes unsustainable at that point, and that the market reacted to that. If we think that the market cap, the present value of all future cash flows, which sets the valuation for companies, discounted at weighted average cost of capital, if you have a long end of the curve going up, if you have a 10-year going up, you're going to have lower present values. So there is as good an answer as I can give you, because the market over the next few days did not care. Said, there we go. Oh, we went down. Hang on. What's that technical thing? It's a V. Let's get the V going. And up we went. So I don't know that there's any correlation between the real world and the market anymore, other than the only thing you could say is the letter V is highly correlated with everything. Also, when you're holding a stock through earnings like Lulu, what is your exit strategy if it gains or falls sharply? Well, risk management always comes in before exit strategy, right? If you have an asset that's not working out, you engage in risk management, but you must be clear as to what asset you have. Let's think about a dog, because I rescued a dog while I was down here, a little Heinz 57, a Benji dog. It's at the vet now. It's going to be there for a day or two while it gets rehabilitated, and then I'm going to ship it to Canada. It is not a dog that you're going to let walk around your house. Why? It lived outside. It's not house trained. So when you get that particular asset, you don't wait until something doesn't work out before you engage in risk management. You know it's going to shit all over your carpets. You know it is, because it has no conception of a house. So you get an asset and you would engage in risk management right away, but you wouldn't get rid of the dog, because you'd say, I know what I got. I got an asset which had a particular risk profile. It's the same with a stock. If you are a contrarian investor, you're buying stocks at multi-year lows that you think the story is not over. You must have patience, which means just because you bought it doesn't mean it's going to keep going. It's going to suddenly turn around and go up. If you want something to go up from the time you bought it, you're going to play momentum. That is the biggest paying factor out there, is you're going to play momentum, especially fundamental momentum. You're going to play that. You got to be prepared when you're being a contrarian to have patience. But usually the payoffs are quite big down the road, but not today. So you get this asset, you understand what it is, and you engage in risk management in the style of the risk that you've agreed to take on. So you buy it at 200, 215. If it drops to 190, you can't say, oh my God, get me out. You have to say, I knew what I was getting into. You have to imagine a worst case scenario and ask yourself, can you live with it? And if you can't, make your position smaller. Can you live with it? If you can't, don't do it. I don't think Lululemon's going away. If it falls sharply, it depends on what it fell. Why did it fall? And then I'll make an assessment as to what I want to do there. When you see a move like this on gold with the market hitting all-time highs, how do you interpret it? So many interpretations for gold. Is it a move away from the US dollar? Is it a concern about just the sheer level of government debt around the world and the seeming unwillingness of politicians to do anything about it? That's the big problem, is like, it's almost as if everyone is completely unaware of it, or just says, so what, right? Could it be that? Could it be the very real reality that gold yields are simply dropping? that if demand stays the same, the price of gold is going to have to go way up over the next 10 years if you want the same amount of gold being mined per year. If gold didn't have a fundamental issue in terms of dropping ore yields, it may not be at this price, even if the other things were going on. So it is a combination of a lot of things. A scarce resource, a limited resource that is getting more and more expensive to get out of the ground, and good reasons why you may not want to be in the US dollar, and you may not want to hold a central bank may not want to hold another country's debt. So it is a nice confluence of events around this metal. Scott Bessent said the administration is considering implementing a national housing emergency. Well, no. Scott Bessent repeated what came out of Trump's mouth at some point in some meeting somewhere. Bessent doesn't have his own original ideas. Bessent just repeats with incredible smugness, by the way. I don't know if you've noticed that. With incredible smugness, everything Donald Trump tells him to say. So if anything comes out of Bessent's mouth, those are Trump's words, but instead of delivered in a belligerent way, they're delivered in a very high-minded way, that I'm better than you sort of way. So we're substituting belligerence for smugness. I don't know which one you prefer. I prefer the belligerence. It's just more authentic. With support from the executive branch, do you think it's a good time to buy housing, or is the main factor still a long end of the curve coming down? Well, listen, they've said their policies out loud before, and their rationale for their policies, and you think, okay. And then their execution on their policies is a bloody shit show. So this is what they're saying. I would hold back and wait for the execution, because I'm sure it's just not going to be good. I don't know how this group of people ever got successful. These executions, whenever they execute on a policy, it's like they have nobody in the room that has a brain that's ever done anything before. They just think up ideas and say, let's do it. And it's just a shit show. So whatever they do, count on it being a shit show. Whatever Scott Bessent says, he's not saying it. He has no original thoughts. He's not allowed to. It's just he's translating belligerent statements from the Orange King into smug statements from the Treasury. With all the developments with AI happening, do you think in the near future will require fewer experts? No, I don't think so. I think you need more experts, because there simply just aren't enough experts. You mentioned AI will be especially useful for experts, and that in the future, experts have a lower chance of being replaced. Here's concern. There will only be limited positions for experts. Correct. Not everyone can reach that level of expertise. Correct. We're already seeing robots and automation being used in areas like farming, high voltage repair, dishwashing, and other types of labor. Well, we've had robots for years. You say dishwasher. I have a dishwasher. That's a robot in a sense. If you put all your dishes inside its big mouth and you close its door, it will wash the dishes for you in an hour and a half, using a lot of electricity and a hell of a lot more water than you would. I think you'll have more robots. It doesn't matter what you can do mechanically in terms of engineering. It matters what you can do cognitively. And I don't think that code can reach the level of metacognitive skills. It will never be aware. There is no life there. There's just code. That's my belief. If a machine can handle both routine physical tasks and many knowledge-based tasks, then where will all these people displaced from the labor market go? Well, if you're not an expert, it seems like outside of those few expert-level spots, there may be very few opportunities. Yes, I agree. I don't think it's going to be as dire as what we think it's going to be, but I think we have to get used to a new level of unemployment, not 4%, but maybe 6 or 7%. That is the new low. And I'm surprised that our central bankers are not even giving a head nod to it, in their decisions about the rate cuts for the future. If it works with a lag, how do you know that AI isn't going to destroy your world before you decide to cut? I mean, should you not be aware of this? But there's just silence. Not even a head nod. I think there was a head nod once, but just general silence. Maybe these guys just don't use AI, so they think it's, oh, this is just another crypto, right? Well, your position on two things I recently came across. Elon Musk is pushing for universal basic income. Jeffrey Hinton, the godfather of AI, suggests people should learn trades like plumbing. Oh, you want my opinion on these? I'm not in favor of universal basic income. But I imagine if you got rid of every other social program, get rid of welfare, get rid of food stamps, get rid of unemployment insurance, get rid of everything else, you may be spending the same amount that universal basic income would be spending anyways. However, unemployment is temporary. A lot of these support programs are also temporary, or if they're permanent, they're very low, which then forces the recipient to do something about changing their life, changing the situation in their life. But universal basic income, if it's permanent, it will be a strategy. It will be used, and then you'll get more people on UBI than you thought that you would get. It is uncanny how a solution designed to solve a problem will actually get more of the problem it was designed to solve. And then politicians say, we just need the most successful among us to pay a little bit more, and we can solve this problem. So universal basic income, I believe, in the end, will be higher tax rates on successful people. Try to run an MVO for my SAA. Want to find daily price histories for a few ETFs. Do you know of any website? Yahoo Finance. Yahoo Finance has, and you could download it right to a spreadsheet. Yahoo Finance. And I think that takes us to the end of this. That is the end of it. There we go. By the way, if you have the Applied Asset Management module, I have put a new module up within it called Trading Manuals. I'll write it out for you. Manuals, and that is not Manuel, even though I am in Latin America. That's manual. Trading Manuals. And I put the first one, there's going to be a couple of categories, derivatives, equities, bonds. I put the first one up under derivatives, which is energy derivatives. It is 73 pages long. And we go through CL, RBOB, heating oil, and natural gas. I also introduce you to propane and ethanol in there. And also to megawatts if you want to trade something called a spark spread. So there are directional trades in here. There are curve trades, whether you think the futures curve, whether it be in contango or backwardation, is going to flatten or steepen. There's something called a crack spread, which is a trade between oil, gas, and a distillate. Also seasonal effects with natural gas, how you would trade the seasonal effects based on the level of inventory. So 73 pages long, a bunch of examples, worked examples that I go through. So if you haven't seen it yet, the first one for energy is up. And that'll take us to the end of today.